$500. That's not a typo. That's not a metaphor. That is the literal starting capital of traders who eventually moved tens of millions of dollars through currency markets, not because they got lucky, not because they had a secret algorithm or a hedge fund uncle or inside information, but because they understood something about the foreign exchange market that the overwhelming majority of retail traders never figure out, and most of them figure it out only after blowing up their first 3 accounts. Today, we're going to trace that journey from $500 to 8 figures, what actually happens between those two numbers, what the math looks like, what the psychology destroys, and what the ones who made it did differently from the ones who disappeared. This is not a get-rich-quick video. This is a get-rich-correctly video. Pay attention. Let's start with why Forex specifically. If you put $500 into an index fund and it averages 10% a year, you have $550 after year 1. Beautiful, boring, slow. That's the right vehicle for most people's long-term wealth, but it is not a vehicle that takes $500 to $38 million in a trading career. Forex is different, and the reason is leverage. In the foreign exchange market, brokers routinely offer leverage of 50 to 1, 100 to 1, sometimes 500 to 1 in less regulated markets. What this means in practical terms is that with $500 in your account, you can control a position worth $50,000. A 1% move in your favor on that position doesn't make you $5. It makes you $500. You just doubled your account on a single trade. Now read that again, but in the other direction. A 1% move against you? Your account is gone. That same leverage that makes explosive growth possible makes explosive destruction equally possible. This is not a footnote. This is the central fact of Forex trading, and the traders who made it from $500 to 8 figures understood this asymmetry at a level most people never reach. Leverage is not an advantage. Leverage is a tool, and like any tool, in the wrong hands, it's a weapon pointed at yourself. The market itself is the largest, most liquid financial market on the planet, $7.5 trillion traded per day. Governments, central banks, multinational corporations, hedge funds, and millions of retail traders all moving through the same system. The opportunity is real, the competition is fierce, and the math, used correctly, is genuinely extraordinary. Let's do the math that most people skip because it makes their head spin. But once you see it, you can't unsee it. The target is consistent monthly returns, not 100% a month, not gambling, consistent. Professional Forex traders at the top of their game target somewhere between 5% and 15% monthly returns on managed risk. For this breakdown, let's use a conservative 10% per month. $500 compounded at 10% per month. Month 1, $550. Month 6, $885. Month 12, $1,570. Still small, still feels pointless. This is where 90% of people quit, or worse, abandon the plan and start over-leveraging to speed it up. That's the graveyard. Stay with me. Month 18, $2,800. Month 24, $4,900. 2 years in, still less than $5,000. This is the desert. The long, invisible, faith-testing stretch where the math is working, but you can't feel it yet. Month 30, $8,700. Month 36, $15,500. 3 years. Now you're starting to see something. The slope is changing. Month 42, $27,500. Month 48, $49,000. 4 years. The same 10% that made you $50 in month 1 is now making you $4,500 in a single month. Nothing changed except the base. Month 60, $154,000. Month 72, $490,000. Month 84, $1,550,000. 7 years from $500. 7 years of consistent, disciplined, 10% a month execution. 7 figures. And from there, month 96 puts you past $4.9 million, month 108 past $15 million, month 114 approaches the $38 million mark, less than 10 years, starting with $500 on math alone. Now, is 10% monthly sustainable indefinitely? No. Does the real journey have drawdowns, losing months, account restructuring, capital additions along the way? Absolutely. But the framework is real, the compounding engine is real, and the traders who made it understood that the math only works if you protect the base. Always. Nobody goes from $500 to $38 million in a straight line. The journey has distinct phases, and understanding which phase you're in changes everything about how you should be operating. Phase 1, the destruction phase. Almost everyone starts here. You open an account, you watch some YouTube videos, you find a strategy, you start trading, and you feel something in those first few trades that is genuinely dangerous. Excitement. In phase 1, you're not trading the market, you're trading your emotions. You move positions because you feel something. You close early because you're scared. You hold too long because you're greedy. You double down on a losing trade because your ego won't accept being wrong. Most traders blow their first account in phase 1. Many blow 2 or 3. The ones who make it treat the destruction phase as tuition. They keep the losses small, $500, $1,000, $2,000, and they extract every lesson available from every blown account before moving to the next. The traders who blow $50,000 in phase 1 trying to shortcut the process, they usually don't come back. Phase 2, the mechanical phase. This is where the work begins. The trader stops improvising and starts systematizing. They develop a defined strategy, specific entry criteria, specific exit criteria, defined risk per trade, defined maximum drawdown before they stop trading for the day. They journal every trade, entry, exit, the emotional state during the trade, what the setup was, what happened, not to feel good about winners, to identify patterns. Where does the strategy work? Where does it break down? What market conditions destroy it? In phase 2, the trader is not trying to make money. They are trying to make their strategy provable. Backtesting, forward testing, small live positions. The goal is a statistical edge, evidence, not hope, that the approach works over a large sample of trades. This phase is slow, unglamorous. Nobody posts their journal on social media, but it is the entire foundation. Phase 3, the scaling phase. This is where the math from segment 2 actually applies. The trader now has a proven edge, documented over hundreds of trades. Emotional control is not perfect. It never is, but it is managed. The system runs the decisions, not the feelings. In phase 3, the trader begins compounding aggressively. Position sizes scale with the account. Risk management tightens because the stakes are higher, not looser. Capital additions accelerate, either from profits extracted from earlier wins or from external investors who now have documented performance to evaluate. $500 accounts become $5,000 accounts. $5,000 becomes $50,000. And somewhere in this phase, the math starts doing things that feel almost impossible until you remember you saw it in the numbers back in segment 2. Roughly 70 to 80% of retail Forex traders lose money. That's not a secret. Brokers are required to disclose it in many jurisdictions. So what is different about the ones who make it? Number 1, they define risk before reward. Every single trade before it is placed has a defined stop loss. Not approximately, exactly. They know the maximum they will lose on this trade before it opens. The traders who failed never had this discipline. They moved stop losses. They held losing trades hoping they'd come back. The winners treat the stop loss as sacred. Number 2, they never risk more than 1 to 2% of their account on a single trade. At 1% risk, you can lose 50 consecutive trades and still have 60% of your account. The math allows for survival through losing streaks, and every strategy, no matter how good, has losing streaks. The traders who wiped out were risking 10, 20, 30% per trade trying to grow faster. They grew faster, straight into zero. Number 3, they decoupled their identity from any single trade. A losing trade is not a personal failure. It is a statistical outcome in a probability game. This sounds simple. It is extraordinarily difficult to internalize. But the traders at the top of the mountain placed thousands of losing trades to get there. They processed each loss and moved to the next setup. No revenge trading, no emotional spiraling. Next trade. Number 4, they treated drawdowns as data, not disasters. Every strategy has a maximum historical drawdown. When you're living through that drawdown, when you're down 15, 20, 25% from your peak, it feels like the strategy is broken. The winners checked whether the losses were within the expected parameters of the strategy. If yes, they kept executing. If no, they stopped and investigated. Discipline in the drawdown separates the professionals from everyone else. Here's the piece of the $500 to $38 million story that the math alone doesn't capture. At some point in the journey, usually around phase 3, something shifts. The trader is no longer working with just their own capital. Performance gets noticed. Documented, consistent, risk-adjusted returns attract capital. Family members, small investors, prop trading firms that fund traders with proven track records in exchange for a profit split. PAM accounts, percentage allocation money management, where retail investors allocate capital to a proven trader and share in the returns. Suddenly, the trader managing $80,000 of their own money is managing $800,000 of combined capital. The 10% monthly return that made them $8,000 is now making them and their investors $80,000. Their personal cut? Still life-changing. This is the acceleration phase. The math jumps not because the percentage changed, but because the base multiplied through trust, through documented performance, through a track record that speaks without the trader having to say a word. The $500 starting account was never the ceiling. It was just the proof of concept. I won't let you leave without this. Most people who try this will not make it to $38 million. Most people who try this will not make it to $38,000. Not because the math is wrong, the math is airtight, but because the psychology is harder than any equation. The discipline required to follow a system when it's losing. The patience required to compound slowly for years before the curve turns steep. The emotional control required to place the same clean trade after 5 consecutive losses as you placed when you were on a winning streak. These are not skills that come naturally to human beings. They run directly against our instincts. The people who made it didn't have better instincts. They built better systems, and then they subordinated their instincts to those systems every single day, for years. That is the real secret. Everything else is just math.